Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Bob Yawger. He's a senior energy analyst over at Mizuho Americas with an update on the oil market. And Bob, you would think that we weren't going through a pandemic. It's essentially like we went from all-time highs to recession to depression back to all-time highs within a span of not even 100 days.
Yes, it's a head scratcher. There's no doubt about that. In crude oil, what we have on our hands here is a very interesting time. You have demand construction as a function of today's job report, and you also have a bid in the market from the OPEC folks who are moving forward to extend their production cut program by a month. Both these events basically happening at the same time. Really, it's the opposite of what happened in March. March is very interesting. You had a failure, an OPEC meeting blow up. At the same time, the coronavirus was starting to impact the United States for size. Crude oil gap opened lower on March 6th and left a top of the gap versus 41.05. Basically, our high today is 39.50, which posted up just after the jobs report. We're about $1.50, $1.55 away from closing that gap. That is a huge target for the technical analysis folks, and it is now within striking distance. Problem is, this market is so extended. It's been so long, to use the same word twice in one sentence, that it is reaching levels that are easily, arguably, above and beyond. It's starting to lose momentum a little bit here, but we're so close to closing that gap. It's going to be a challenge here in the next couple of days, but that is the target, 41.05.
Do you think that the supply and demand picture warrants oil to be at those levels? Certainly we're not traveling or driving or cruising like we did just 2-3 months ago.
Yes, I'm very skeptical about the whole thing. I mean, all you have to do is look at the weekly EIA storage report. And the one big number, and probably the most important one, is the refinery throughput. The United States, this week, we got the 13 million barrels that we send through the refinery every day. That's about 71% of refining capacity here in the United States. That's versus about 17 million barrels last year at this time. This is usually when refineries run at their highest levels, and the refineries just cannot do that right now because they make so much gasoline that there would be no place to put it all. Not to mention, you can't make gasoline without making heating oil. So you would have incredible amounts of heating oil on the sidelines. The heating oil versus crude oil, which is a financial function known as the heating oil crack, is already trading at its lowest level ever because nobody needs heating oil right now. But you can't make gasoline without making heating oil. So, yeah, the run rates are really low. In my opinion, it does not justify very elevated levels. But that said and done, $39 isn't exactly a rip-roaring to the upside either. It's come a long way. We had the best month ever in the month of May, but we literally bounced off of zero. So we have come a long ways. We came a long ways from a long ways down. We are still at pretty roughed up levels, though. First thing we need to do, I hate to keep harping on the same issue, but we need to close that 41.05 level. If we get above that, you are it's a stretch of the imagination, but you are in normal crude oil trading area. At $40, producers in the shale space, they can actually start making money. So that's also another big factor. And another reason there are going to be plenty of folks gunning for that $40/41.05 number.
Yeah, and if we take a look at the RBOB chart that you have there, what are you seeing there? I would imagine it's largely in line with what you were saying, that there's no product for anything to be refined.
No, you could argue, though, that RBOB is, on any given day, is leading the way higher. It's a function of when you lift some of the restrictions on travel, the most natural commodity that comes to mind is gasoline. People are going to start driving again. And it's my observation that that is definitely the case. There's not traffic out there, but at least there's people on the road. There was a long stretch there where, I mean, I run 7-8 miles a day, and there was times when I didn't see people on the road for 5-10 minutes. That never happens anymore. There's always cars on the road now. Not like it's good old days, but there's definitely some demand. But gasoline is key. The reason gasoline is key, I mean, gasoline is actually at a very beaten down level versus $1.20 here also. It's not rip roaring. And it's still like 13, 14 cents away from closing that gap in that commodity. But you need gasoline during summer to do well. If you don't need gasoline, then you don't need crude oil to make gasoline. That's when you really have a problem. Now, the gasoline crack, that's the relationship between gasoline and crude oil, it's trading about $11 this morning. Certainly not rip-roaring, but the refiners are probably making about $1 on that. Anything below $10, they're really not making money. That crack needs to be above $10, and it is above $10 today. And I'm sure that there's some refiners that are happy about that today.
All right, Bob, great to have you with us as always. Thanks so much for joining me on Trade Talks.
Thank you, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.